Thank you very much. Good morning and welcome to FirstWave's FY23 Q3 update. My name's John Grant and I'm non-executive chair of FirstWave. I've got a bit of a croaky voice this morning, so my apologies. I'm joined by CEO, Managing Director and Major Shareholder Danny Ma and Chief Financial Officer and Company Secretary Ian Bartram. You can see the agenda for today on the slide. I'll make a few introductory comments before handing over to Danny to take you through the highlights for the quarter. Ian will then deal with the financial performance before handing back to Danny for a broader update. We'll then open the call for your questions. When a company like FirstWave is on quarterly reporting, sometimes the business cycle doesn't match this reporting cycle. It's a bit like that this month, this quarter at least for FirstWave. When we were putting this presentation together, Danny described it as not so sweet, but not so sour either. We've had a great cash result, generating positive cash for the quarter, the first time I can remember in the almost 3 years I've been with the company. But this too is a bit cyclical, as Ian will describe. But on the other hand, we would have preferred a higher level of sales, which Danny will expand on. That having been said, it's my view that we're running a very lean business well, and the cycle back to revenue growth is ahead of us. Let me now hand over to Danny.
Okay, thanks, John. Sorry, so basically the highlight of the quarter is that it was cash flow positive, and that is amazing for this company, and Ian will go through in more detail on how that happened, but we're really pleased to be able to report positive cash in the quarter while we're continuing to invest in growth, particularly in sales and marketing. We saw a little bit of growth in our network management annual recurring revenues, around 2.3%, and we saw a little churn in our Cybercision recurring revenues around 2.5%. So disappointingly, they pretty much cancel each other out. So we didn't get the growth that I wanted in the quarter. But importantly, the pipeline is in good shape and the deals have just slipped. They're not lost. So we're continuing to make those investments in sales and marketing. And it's just taking that touch longer for some of these deals to drop, but they're there. Our non-recurring revenues were lower than the previous quarter. As we communicated in the previous quarterly update, we had some once-off license upgrades, in particular in Latin America. December is the end of the financial year in most countries outside of Australia. So we do get some lumpy once-off spending in that final quarter. And that's basically the highlights and the summary of the quarter. And I'll hand over to Ian for now to run through the financial performance, and then I'll come back for a bit more of an overview.
Thanks, Danny. Looking in more detail at the key financial results for the quarter, the revenue recognised in the quarter fell by just under 18%, which was almost entirely due to the reduction in non-recurring revenues. Recurring revenues were flat, which is reflected in the ARR result of 9.82 million, down just 0.4% on Q2's 9.86 million. As Danny noted, this was the net position after a 2.3% growth in monitoring revenues and a 2.5% decline in Cybercision. Gross profit fell in the quarter in line with the reduction in revenues. There were further write-backs of COGS accruals in Q3, leading to similar adjustments to those made in Q2. And therefore, to ensure a like-for-like comparison from quarter to quarter, both the actual financial results and an adjusted result where the impact of these accruals is removed has been presented. So in summary, revenue is down, ARR is flat, and gross profit has fallen in line with the reduction in revenue, and hence the gross profit margin is consistent with the previous quarter. Moving on to the cash and expenses, the business finished the quarter with just over 7 million in cash and cash equivalents. This is 390,000 more than the cash held at the start of the quarter and is a $2.3 million improvement in cash usage when compared to the previous quarter's 1.9 million of cash used. There are three things to note about this movement from cash usage to cash gain. Firstly, collections in the quarter were 900,000 higher than the previous quarter, which reflected the collection of the large perpetual license fees in Q2 and the seasonality in the North American renewals. Secondly, the receipt of the $1.2 million in R&D grants that had been flagged as pending in the previous quarterly update. And thirdly, the underlying improvement in the company's expenses, And it is only on this foundation that the two cash inflows from collections and R&D have resulted in a positive cash flow quarter. You might remember I commented in the previous quarter's announcement that the business's non-recurring revenues are harder to forecast than recurring revenues, and yet they are a significant component of the monitoring side of the business, and hence we need to accommodate them in the analysis of normalized cash burn. In Q2, we included a breakdown of the one-off revenues factored into this normalized cash burn. We will continue to include this breakdown, and to reduce any subjectivity in this calculation, we will now adopt a fixed methodology for calculating the one-off revenues impact on the normalized cash usage. The methodology being adopted from this update is to take the actual non-recurring revenues recognized year to date, expressed monthly, which for the end of Q3 is 110,000 per month. Using this methodology, the normalized cash burn at the end of Q3 is 560,000, which is up 80% on the Q2 level, but includes a 90K reduction in the benefit from one-off revenues. So in summary, the costs in the business continue to fall. As I also note that the business continues to invest in sales and marketing to the tune of 400,000 a month, which is just over 30% of the business's cash expenses. As commented on by both John and Danny, we would have liked more new sales in the quarter. However, we remain confident that the growth anticipated from the pipeline, together with tight cash management, will result in the business reaching our target of cash flow break even. I will now hand back to Danny to provide some further comments on the quarter and the business's current performance.
Okay, thanks, Ian. On each of these updates, I do recap on our strategic objectives. It's probably becoming a bit mundane to go over them again now, but I do want to continue to reaffirm with all shareholders what the focus of the business is. It's a sales-led culture, growing the revenues faster and being capital efficient. So everything we do falls under one of those pillars. If it doesn't, we don't do it. Okay. There were again some key sales initiatives in this quarter. We saw 2 new account managers join the team. Patrick joined in the USA, which I'm very excited about. Patrick is a very, very talented account manager who previously worked for Opmantec, so it's great to have him back. He will be focused on selling the network management products in the US. I'm also very excited to see Paola joining us in Australia. She's located inside of Telstra and focused on growing our Cybersession revenues. This is the first time we've had a sales rep inside of Telstra. So she's a fantastic addition to the team and she's been welcomed with open arms in Telstra. So that's hopefully going to be a big change for us. I've mentioned in the previous quarter's update a significant deal we're hoping to close in the US. That is edging closer and closer, and I check my emails every morning for updates. We're all working hard to finalize it, and we're all frustrated that it hasn't dropped yet, but it is really close. Time always adds risk to these things, and for that reason, we want to lock it in now. But it is edging closer, and we're hoping to have some very big news on this very soon. We continue to focus our sales efforts on service providers and large organizations in our strongest markets, which are the US, Australia, and Latin America. And we continue to focus on our highest margin products, which are our network management software and our email security offering. In terms of key sales results, we extended our contract with NASA, which is why in my background, I'm sitting on the moon here, for another 12 months. And we actually doubled the value of the contract. That contract has pretty much quadrupled since they first signed. So that's really pleasing. And we hope that it continues to grow as NASA continues to build out their Artemis space missions, which is a really cool thing for us to be involved in as a tech company. We extended our contract with John Deere for another 12 months, which is great. And they've now been with us for 12 years, which is fantastic. We extended our contract with the Canadian Imperial Bank of Commerce, which is a good size agreement for us. And again, it's a great one to have extended for another 12 months. So in summary, our current position is that we're continuing to invest in our growth. A really positive result from a cash perspective, just fantastic. We do still have a good pipeline, and we would have preferred more growth in this quarter, but it's only slippage, it's not lost deals. So we're focused on closing those deals now, and of course focused on closing out that large US contract, which is so close now. Before I sign off, I did want to let you know that this afternoon I'm presenting at the Coffee Microcaps Investment Conference at 3:30 p.m. at the State Library in Sydney is when I'm presenting. So I hope to see some of you there. After we've completed this update, we will upload the slides that I intend to present at that conference to the ASX. So you may want to take a look at those. But I thought I'd include just a couple of them in this presentation as a courtesy to all shareholders. The first one I thought to share was this illustration of the breakdown in ARR. If we focus on the graph on the left, this is the breakdown of our network management annual recurring revenues by geography. Keep in mind that these products are 100% gross profit to us. Every dollar that is spent on these subscriptions we keep. So we can see the bulk of our revenues, 54%, come from North America, which is also great because that's our primary target market. Latin America, 26%, which is primarily the American Mobile Group, Telmex and their sister companies, the Claro in various countries. And we've got 14% in Australia, which is interesting to me because it hasn't been a big focus of ours to sell this tech in Australia, and there's natural opportunities here. The middle graph is our Cybercision revenues. So we can see the Cybercision revenues continue to be very concentrated in Australia, 95% of them, in fact, with most through our partner Telstra, and we have a small amount of revenue outside of Australia. The graph on the right shows our total ARR with 58% coming from Cybercision and 42% from network management. I note that Cybercision ARR is approximately 60% GP. So if we did a graph of ARR, GP ARR, it would be about 55% network management and 45% Cybercision. So we do have a good mixed blend of revenues between the two products. At the conference, I'm also going to talk a little bit about the blue sky opportunity for FirstWave. So I thought I'd pull in a couple of slides about that. The first blue sky opportunity the company has is to unlock the potential of the IP that we now own post acquiring Opmantec and integrate some of that with Cybercision. Basically, if we think about what Cybercision does, it takes some clever third-party products, gets them into a platform which makes it easy for a service provider to take those capabilities to the mass market at scale. So we now have some pretty significant IP in areas such as compliance management, secure IoT management, and audit. So it's about getting some of that IP onto the Cybercision platform, which I'm sure will be particularly interesting to all organisations, but especially Australian state and federal government, where we're getting a lot of interest in taking those forward. The second blue sky slide that I'm going to present at the conference is around our open source user base. There are around 150,000 organisations that we estimate use our free open source software. So that's the free version of our network management product and the free version of our IT audit software. These organisations are spread around the world in 178 countries. This is a typical geographical spread for any large tech companies. Cisco, Microsoft, etc. have similar spreads. And we haven't done a lot to attempt to monetize this. And it's a significant opportunity to do that. And we are considering ways to do that. These are very sticky products used widely around the world. And we're thinking, what commercial hooks can we put into the free products? What approaches can we take to get those free users to buy something? So it's something we're investigating as a blue sky opportunity. It's massive. It's a huge user base. And you may hear a little more about this in the future. Okay, so that's all I wanted to run through with you at this point. So I'll hand back to John to facilitate some questions and look forward to those.
Thanks, Danny. Let's now move to your questions. You can type them in on either the chat or the Q&A function or raise your hand to speak. Over to you. Any questions, please? Nick, you've got your hand up. Welcome, Nick. Nick Harris from Morgans.
Thank you, John, Danny, and Ian. Appreciate the presentation and giving me a chance to ask some questions. Also, great to see your cash balance go up. Definitely noticed. So, and to see those underlying expenses continuing to decline. So excellent. Just a couple of questions from me, really. One was, Danny, you mentioned on the slides that sales slippage this quarter. I was just wondering if maybe you could elaborate. Do you think customers are being a bit more cautious or changing their behavior, or do you think it's just a timing thing? And then my second question was just, you mentioned you've got a new staff member who's, I think, inside sales now at Telstra. So I think that's also a bit of a first for the company. Could you just talk a little bit about what she's doing there and what her objectives are? Thank you.
Sure. So on the first point with the slippage, No, it's kind of normal in the fields that we're operating. You know, with the network management software, most organizations have something. So they're replacing a system, and it's quite normal for, you know, just for them to get busy with stuff, and then it just slips a month or two. A lot of the deals we had were kind of, you know, we've internally forecasting around March. So they were at the back end of the quarter as well. But there's no particular underlying issue there or anything like that. It's just one of those things where it's still a fairly lumpy business. So a few deals slipping from one quarter to the next make a difference to that quarter. As John said, it's actually not really suitable to do quarterly reporting in that situation, because there's actually no underlying issue. The deals are just going to pop up in a different quarter. But when you do quarterly reporting and they're sitting on the edge of 1 month to the next month, that's how it works. So there's no real underlying issue, and I would have preferred them to come in the quarter, but I don't really have any concerns with any of the deals. In relation to Paola at Telstra, she is part of their sales team. So she's a specialist on our products, or the Telstra branded version of our products, more to the point. And her job is to work with the account managers and ensure that our stuff is sold. So she's solely targeted on sales of our products through Telstra. And yes, you're right, that is a first for the company. It's the first time we've had someone inside the Telstra sales team representing our products. So it's really cool, and we'll see the impact it has.
You happy with that, Nick?
Yeah, that's great. Thanks, John and Danny. Appreciate it. Thank you.
Thank you. We've got a message on the chat line, or Q&A line at least. Moving forward, if there are any contract wins and FirstWave reaches cash flow break even or positive, but there is no share price re-rate from the market, would you consider buybacks as a form of capital management? Cheers. So my response to that would be, it'd be lovely to get that position. I think it's a big call for a company like FirstWave to enter buyback territory when they just turn cash flow positive. I think we'd be putting some money in the bank, quite frankly, for a little while. And my first inclination after that would be to start paying dividends, but that's a long way. You know, it's a long way away. And it's a big call now. Ian, do you have any observations on that can expand on what I've said, or different to what I've said?
That would have to have come on the back of the right investments and the right contract wins, which would lead you to think you would be better off making further investments if there's opportunity to do that. If you're growing the business in that way and you're making those decisions, then that's probably a first place. But I completely agree with you. We'd be putting some reserves in the bank before we went out spending.
Any more questions, comments from anyone? Okay, thank you very much. Thanks very much for your attention. We'll speak to you again next quarter, and as Danny indicated, hopefully before that with some good news. Have a great day. Cheers.